Investing in 2008. 2008 was the kind of year I had somewhat been waiting for, as ghoulish as that sounds, because my opinion was that the methods and the men don't work in the world of investing. They simply don't beat the market. I waited till today, it's January 31, 2009, to see if the January effect would play out. This is one of the great anomalies where the stock market does better in Januaries than in other months of the year. And apparently the market's down 8.fraction% in January, so there wasn't much of a January effect for the year 2008. And in 2008, we saw all the big brawny players fall flat in their face. Bill Miller, the great mutual fund manager, his return was so bad that his rate of return over his entire history is about average. We saw the hedge funds get killed. The reported rates of return for hedge funds are probably not as bad as they really are. And we saw the endowments get hit. Their fiscal years generally end at the end of June. We'll see what happens to them. And we saw all the big mutual funds, even the big diversified ones, didn't do that well. Fidelity Contra Fund and so on. And one of the things you noticed was that a lot of the best fund managers out there, they had big slugs of stocks of companies like Fannie Mae and Freddie Mac and Lehman Brothers. Fannie Mae stock price was way high in January 1. By the end of the year, it was below $1. Why did they buy that stock? Well, as the great economist Paul Samuel said, the stock market is efficient at the micro level, that you can compare one stock to another, but at the macro level it's hard to tell. The whole market might be too high. So people were buying big slugs of those what seemed like really safe companies, figuring that if you had to allocate a $10 billion portfolio and you had $5 billion in those kinds of companies, you'd be okay. Didn't work out that way. And then other grand ideas in investing that were blown up in 2008, the idea of investing for the long run, that over any 10-year period you won't be a loser. That doesn't look too good today. And the idea of diversification, that if you held foreign stocks and high-yield bonds or something, and U.S. stocks, you'd be okay. But all three of those categories went down a real lot during the year. The things like the magic of compounding. The sooner you start investing, the more you'll have. Well, that didn't work out. Another idea called dollar cost averaging. This is the hokiest of ideas. There's different interpretations of dollar cost averaging, but it goes something like this, that you buy stock and you hope that the price of the stock goes down so you can buy more of it later at a lower price. Yeah, that's the way they talk about it, such you have an overall low average cost. Now, it shouldn't make any sense that you ever buy anything if you think it's going to go down in price, so I don't know why you'd ever want to do dollar cost averaging, but you should have had a great year in 2008. Like I said, Fannie Mae stock, I think it was around 40 or something at the start of the year, and now it's below $1. So if you're a dollar cost averager, you should be really, really happy that your Fannie Mae stock went way down. And the same thing with technical analysis. Those are the people who track charts and they find triangle shapes and breakouts and head and shoulders and Bollinger Bands and Japanese candlestick formations and so on. I don't know how good a year they had. My guess is that the market was down so much that it blew any of those technical systems out of the water. Anyway, I haven't read a lot of articles about technical analysts who did really well that year. So this is an intro to some of the things about investing and how truly uncertain it is. And I'm going to go ahead now and do some more detailed things, and in particular talk about some people in the investing business who I think are very pretentious. And stay tuned for more on specific techniques of investing on Maximize Utility.